Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. What's up, everybody? Welcome back to another Roundup edition of Forward Guidance. We got the trio back once again. What's going on, guys? How you doing?
Good. I'm sporting my throwback Kobe, Jay.
Oh, wow.
Just, I'm not an LA fan, but I like Kobe and the Dodgers. I had to shout out to their victory.
Are you been lifting lately? Look at those guns.
No, dude, I am weak. I have a couple month stretch here where I'm done with travel and I'm just
he's been lifting bids. That's what he's been doing.
Yeah, true.
What's that hat say? Buy low, sell high. Nice. I like that.
It's my buddy's Onda. I think it's ONDA. It's a cool little clothing brand he's got.
Well, look, we are recording on Friday morning. We just got the jobs report. We're about to go into one of the biggest weeks of our lifetimes until the next most important week of our lifetimes. No, but it actually is going to be a pretty important fundamental. We got the jobs report this morning. We got the election coming next week. We got the FOMC meeting the day after. There's a lot going on. Obviously, the main data points that we got this morning is the jobs report. So I'm just going to go through a few slides and just get everybody level set on what we actually saw. So if you just remember back to, we recorded a live edition of the Roundup at permissionless. Unfortunately, Tyler was not there. Mike stepped in. And then, of course, Quinn and I were there. And during that time was right when all the hurricanes were starting to occur, and we had mentioned that it was highly likely that the next month was going to be a pretty significant miss to the downside on the jobs report. It was going to come in pretty soft, and also that the previous jobs report, which was pretty much a blowout one, I think was an outlier outside of the mean trend. So it was quite likely that we were about to see some sort of a mean reversion. So far, that's mostly what's happened. So I'll just go through a couple charts here. So the first things that's off, is talking about the actual jobs report itself. So the non-farm payrolls came in at 12,000 jobs. The consensus forecast was 113,000. Shout out to Anna Wong from Bloomberg. She was the most correct on this. She actually had forecasted a negative jobs print, which really ties into what's on this chart, which is just when you bake in revisions. We probably just saw a negative jobs report today. I tweeted about this morning, but just based on how the initial print is calculated in terms of like a 90% confidence interval, the range is basically 100,000 jobs plus or minus. And considering the fact that we're in this trend of negative downside revisions, we probably just saw a negative print. So looking back at the last couple months, we saw some negative revisions to the previous prints. August went from, we saw a decrease of 81,000, so from 159,000 to 78,000. And last month, we saw a decrease of 31,000 revision from 254 to 223. Again, this is something I've been harping on a lot about. It's quite linear, this decrease in revisions. It's quite predictable, so you can pretty much just like bake it into your analysis and move on with your life. You don't need to get upset and throw a fit about revisions. It's fairly predictable, and that's what we've seen here, and that's what we're probably going to see today, and that's why I'm pretty confident that we saw a negative print. The other of note is the unemployment rate. When you look at the unrounded number, just to set the stage here, if the official print was 4.1%, which was flat. But when you actually look at the unrounded number, we actually increased from 4.05% to 4.14%. So we almost saw like a 10 basis point increase. Again, there's a lot of noise due to hurricanes. So you can see here, 512,000 people were employed but absent from work due to weather. And then the other one as well, setting aside from hurricanes, is the strike. There's some significant strikes, especially from Boeing. And that led to a pretty negative print in durable goods manufacturing, where we saw a 47,000 job decrease because of that. this is something that was really interesting, and this is a print that would not be affected by some of these dynamics that we're talking about, is looking at the unemployment by cause. And if you look at the black line here, the permanent layoff, it was actually just hit a cycle high. So this is permanent layoffs. It has nothing to do with temporary layoffs from hurricanes, from strikes, anything like that. That has nothing to do with new increases in immigration. This is a very substantive metric, and to see it break out on a cycle high is of note. It's not skyrocketing, but it should be noted that it is hitting a new cycle high here. And this is something that we actually flagged last month, that if you use the unrounded data, the SOM rule reversed. I just wanted to flag that using the official 4.1% number, we've officially seen that reverse, which is really interesting, and we can get into. A couple other ones here is just looking at where the job growth was. Once again, people harp on a lot is that most of the job gains are coming from the public sector. So private education, health services, government. That's where all the job gains are. And then if you look at the bottom, manufacturing, professional and business services, that's where all the job losses are. And again, digging in a little bit deeper, you can see just in terms of the change in full-time jobs year over year. If you look at the private sector, it's not great. You do have to admit that a lot of the positive jobs momentum that we've seen has been because of the public sector, and then that should be noted. And based on that, we actually just saw for the first time since December 2020 that we saw the first negative print in private non-farm payrolls jobs growth. So that's also notable. And then to wrap it all up, we saw earlier in the week is that the JOLTS report came out, so job openings, which saw a pretty significant miss, a 7.443 million versus the consensus 7.99, which really just signifies this is why the Fed is so keen on cutting rates right now, is they don't have the slack in job openings anymore that they used to. So that's why they're able to just let things kind of build up. But now we're getting to the point where, there's a ratio of basically for each person that's unemployed, there's one job opening, which is very different from 2022, where it's pretty much double that. So taking all that together, what are the main takeaways? There's a lot of noise, but there is some significant noticeable weaknesses that we can see, setting aside the noisiness. But of course, when you look at the negative jobs print that we got today, a lot of that is attributable to these temporary layoff dynamics that we flagged back in that live recording a few weeks ago. So based on all of that, to me, it feels like 25 bips cut in November next week is a lock. I would even say that the December cut is a lock. And with that, I want to open it up to you guys and hear what your big takeaways are from this morning's data.
Yeah, I think the funny thing that it reminds me of is when the Fed, started to have different sorts of readings on inflation back in 2022 or 2021, when they're kind of say it's transitory. It's like inflation X this, and then every month's report, we got an extra X, like X, then it's just down to super core, which is
X
measuring
everything.
It's always zero. And I feel like we're going down that path, right? X hurricanes, X strikes, X government jobs that are fake, X this, and you're we're at zero growth so I just think it, like you said, it's so noisy, and there's the revisions is probably the most interesting thing, because when you think about minus 100 plus negative revisions and the BLS, the Fed has said they believe there's a good, that 800K negative annual revision, divided by 12 for each month. They kind of apply that to their frame of thinking. So yeah, it doesn't alter the path at all, I think, from what they set out in September. And yeah, I think we're going to get 50 more bips and maybe a pause in January, but it's going to be data dependent. And I think this is kind of setting up perfectly for the Fed.
I'm more concentrated on potential policy changes in the election, but because that can really change a lot faster than what a jobs number does. But I'm with you. I think it's a 98% chance now. The market's pricing in for a cut next week, so it's pretty baked in at this point.
Powell has repeated for multiple meetings now that they do not view any inflationary pressures coming from the labor market. And so as you're predicting the path forward, post September, we've had, inflation's just kind of been meh. It's kind of continued to stumble lower or flattish. and we've had a couple readings of hotter jobs and now a reading of lower jobs. So like nothing's actually changed from September. They still are going. This report is not going to change their mind that there's potentially now inflation coming from the labor market. And they also talk about JOLTS, quits, leading wage growth, right? That slack and tension.
Exactly.
And so ECI as well, Thursday came in line and continues to look forward as probably falling. So yeah, there's just nothing in these reports that would deter the Fed's projected path from September, in my view.
Yeah, I think it's important to really emphasize just how not worried the Fed is about inflation right now. And you know what? Somewhat justifiably. Like, we got the PCE prints this week, and people were throwing a fit about core PCE being elevated. And yeah, for sure it is elevated. And the vast majority of the reason for that is shelter inflation, which just has to do with the lag nature and how we calculate it. It's the way we calculate it is a flawed metric that was created back when we barely had computers. So we just had to do our best guess. But like, we can get real time rent data. Just go look up Zillow. Yeah, the vast majority of the core PCE is just shelter inflation. Then you look at everything else. We're in a pretty good spot. I posted that. Okay, the Fed officially targets PCE. They've said in moments, oh, we look at core PCE, oh, we look at super core PCE. But if you go to their website, they target PCE, and they target a year-over-year percentage of 2%. After this week's data, we're at 2.1%. You look at that, you look at oil that's just on the floor, sub $70. You look at these wage dynamics that you just talked about in terms of, just potential like wage growth concerns. There's none of that. Like the big three-pronged issues are just on the floor. So, why would they start to care about stickiness in shelter at this juncture versus what we're seeing in the jobs market? Again, like we saw a pretty big miss in the JOLTS report. There is some cyclically, somewhat, I don't want to say concerning issues in today's jobs report, but obviously, like we saw, like layoffs are increasing. It's just, it's not at a very concerning pace yet. We've seen the somber reverse. That's how little momentum there is in it. But still, there's really no reason for Fed funds rates to be as high as they are right now.
Yeah, I'm kind of with you on December likely being a lock as well with this report.
The contra is everyone's probably saying, oh, the market's near all-time highs. Why the hell are they cutting? Which I think is kind of fair, but that's obviously not the metrics they're looking at.
No, the Fed doesn't give a shit about
the market. Yeah, if inflation was at 6% and the market was ripping, then they would care. But inflation's not. So
yeah. So what was really interesting about this morning, though, is that we got the jobs report and yields were crushed. Especially like the 2-year just came, just crashing down. The long bond was coming down. But then, we got, it looked like what triggered it was we got like an ISM manufacturing prices paid print that came in at like 54.8 versus the consensus was 48.5. The previous month was 48. So it feels like that kind of spooked people. But we were talking about this, like, I don't know, the ISM is so noisy. Like, talk about noisy bullshit,
I don't know if it's that, or to me, what's happening is if you're a giant sovereign international owner of fixed income, the election really can change a lot. And what I think is happening is they're pricing in some sort of Trump win. And if you're Japan and own some treasuries, you're probably taking some off the table. And because Trump's policies just, I don't know if this is real or not, but no income tax would be like the biggest growth.
It's not going to happen.
I'm just saying, like, if he has a lot of these like crazy ideas where it can change the dynamics of the economy pretty fast, then yields skyrocket and you're seeing stocks actually still up today. So, and I shouldn't say skyrocket. They're up, what,
7% or something
points since on the 10-year. So the yield curve is steepening, maybe on pro-growth policies and a Trump win is sort of what I'm insinuating. And at closer, we get to the election, I thought that yields would come crashing down because it seems like an overreaction. Just if you look at the move index and volatility, people are really getting ahead of themselves here.
Yeah. I think, Tyler, to your point, like so much of the moves right now are just this idiosyncratic like vol stuff that you keep a tight track of, that like, the more traditional fundamental moves, you're like, oh, why is the yields surging right now on a soft NFP? So maybe that's a good segue into some of the charts that you got going on in terms of just what you're seeing in like significant hedging and volatility right now.
Yeah, well, let's do a little cross asset smash here.
Okay.
Maybe I'll hit you with slide 43. So this is the high. I always look at the high yield market for the proxy of like what's going on in credit. And if you look, this is the double B spread, the B spread, and the triple C spreads. They've come in like they're at the lows. So all of the stuff is at the sovereign level, right? Now go to the next chart.
That triple C move is insane.
Yeah, that's partly, I think, it's idiosyncratic from like it was
yeah.
Dish Network or something. They upgraded.
Oh, okay.
Yeah. So, and then this is a great one. The number of bond issuers has decreased by 83 or 8% since the beginning of 2022 to 910, which is the low since August 2020 and comparable to 1999's historic peak of 1,133. This is the third consecutive year of the number of high yield issuers are declining, basically saying there's less supply in high yield. So credit on the corporate side, especially in like the riskiest, tranche of credit, is pretty good. Now go to the next slide. This is leverage loans. And this is Quinn's old world. I think you did leverage loans, but the coupon on leverage loans is coming down because the Fed's lowering rates. Get this, in terms of interest expense, loan borrowers have saved roughly $2.9 billion of annual interest costs via repricings. So their cost of capital is dropping on the leveraged loan market as well.
And that doesn't even count the 100 bips, 50 and past and 25 ahead in the floating rate.
Exactly. So this is there's a new credit cycle actually happening on the corporate side is sort of what I'm saying. Corporate bonds are selling off a little bit because of this duration thing, but spreads are in, like credit spreads are in, which basically means, credit on the whole is fine. It's just on the Treasury side is where everyone's kind of freaking out right now. Now go to the next one. This is probably a chart crime because this is slide 46. This is the move index. This is, we talked about this last week. It's US Treasury volatility versus CDX on high yield, which is the orange line. And so you're seeing basically the implied move of US Treasury interest rates like skyrocketing, but CDX on high yield, which is, insurance on high yield or credit spreads, essentially, this is at lows. So the high yield market's not really budging at all. This is just a US Treasury, rate phenomenon.
Yeah. So basically what you're showing here is that we can see bond losses from two reasons, either increase like credit risk or increase duration risk. And the credit side of things is like as tight as it's ever been, really. Like we are in a very good spot.
Yes.
It's more about duration. It's more about higher than expected economic growth versus what's priced into the curve.
Yeah. And it's the sovereign issue. It's on your Treasury balance sheet. It's not the corporate balance sheet, which is kind of an interesting phenomenon. Like you see this move in treasuries and you'd expect spreads to be blowing out and, everyone's calling for a credit crisis, but it's really, maybe it's what I think treasuries are saying is Trump is going to win and maybe there's going to be growth is going to be a lot better than expected. I think that's sort of what the market is trying to tell us right now.
Yeah. I mean, look, like this is something we talked about before. We talked about this off camera, but just comparing, if you want to look at this simply, if you look at HYG versus HYGH, so HYG is high yield credit, and it's down is down 22 basis points today. But then when you look at HYGH, which is duration hedge, so it's purely credit risk, it's up 19 basis points. That's everything. That's the signal.
Shocking, right? Like you wouldn't expect to see that credits firming on the high yield side of things. And you can see it in a lot of companies. Like I watch iHeartRadio, which is like kind of a high yield issuer. It's kind of like breaking out from a bottom here. So there's a lot of weird, funky stuff happening. But you want to get an equity volatility now? The point I'm trying to make here is if you look at where everyone's kind of getting ahead of this election and making bets on certain asset classes. And that's why the move index is really high. And then if you go to equity vol, let's see, we watched this last week, slide 50. This is where I was wrong last week. I thought people overprotected their books, and the VIX would slowly drift lower heading into the election, but it actually got worse because of a couple things. But so the VIX, the white line, this is from our boys at Piper, and we want to have Danny Kirsch on at some point to walk us through. He's got the best stuff.
That'd be awesome. Yeah.
So they'll come on some point, but the white line is the VIX, and then the orange line is the realized volatility, the S&P. So when the spread of these two things, which is the line below, is high, meaning the implied vol is higher than realized volatility, the market's not trading like that crazy, but implied vol is. And that's because everyone's hedging, and you have your systematic buyers. When the VIX goes up, they delever, their stocks. There's all these interesting phenomenons, but we're basically setting up for a crazy event. And then go to slide 48. This is really interesting. There's someone out in the market making a huge bet that the VIX smashes down. So look at these top three lines. This is the VIX November 16 put. Yesterday, someone bought 126,000 contracts of VIX 16 puts in November. And then they bought 112,000 of VIX 15 puts. And then they bought 110 of the VIX 20 puts. So essentially after the election, they're anticipating vol's going to roll off really hard here. And you can see,
wow, you can see like an 18% increase in open interest.
Yeah, that's the other thing.
Yeah.
So there's lots of games with volatility happening here. And I don't know, generally when you get to such extreme levels, the only way vol stays this high, meaning, the VIX stays this high, is if we don't get a winner of the election. I think that's, otherwise you're in the seasonally, really advantageous point where buybacks kick in, trading volumes drop, lots of stuff starts kicking in, and earnings have come out actually better than expected, minus Microsoft and Meta. So, I mean, I don't know. That's where I think this is headed, but things can get wacky here. We're going to see some wacky stuff in the next weeks.
But for vol to stay this elevated, to your point, like it needs to be really wacky and stay wacky, because the VIX, how it's constructed, is they call it mode reverting. I'm not a good enough quant to make the distinction between mean, median, mode reverting, but it's mode reverting, which generally makes it so that we basically need to see consistent black swans effectively keep rolling to keep vol this elevated. So you're kind of on the losing side if you're thinking of going long vol at this juncture.
It's right now it pays to sell insurance. If you think about volatility as insurance, you're better off selling the insurance rather than buying the insurance. No one should be buying options here because the implied moves are very large. I shouldn't say no one should be, but your risk reward for buying volatility right now or buying insurance is skewed poorly. And just to give you a sense, you hit slide 49. This is how far the vol has moved just in the past, let's see, last week. Okay, so the white line is where we currently are. So basically we're inverted, right? The spot VIX is up huge. And then last week was the blue line. So you can see how far we've moved on spot prices and how bad the inversion is now. So the longer you go out, look how it drops. The VIX drops, right now in December, it's priced at 19 or 1936 or something. So there's just a massive inversion right now, which is why, yesterday we saw, and these are all market structure things, but the VIX inverted really hard. And now today's the market's up and the VIX is down. What percent? The VIX is down like 7% today. And that's why, a lot of this protection's rolling off again. So these are all just kind of market structure things. And the setup is, I think it's good for a vol smash and probably a re-leveraging if the election turns out and there actually is a winner. It doesn't matter.
Hey everyone, this episode is sponsored by Ledger. For the past decade, Ledger has been the global leader in digital asset security, trusted to secure more than 20% of the world's crypto assets. Celebrating 10 years of innovation, Ledger is making digital ownership more secure and accessible with their latest products, Ledger Stacks and Ledger Flex. These wallets feature the world's first secure touchscreens, simplifying your digital transactions while ensuring uncompromising security through Ledger's secure chip and proprietary OS. Plus, with the Ledger Security Key app, you can say goodbye to traditional passwords and step up your digital protection. Your entire crypto experience got a whole lot easier. Ready to protect your assets? Choose the most trusted name in hardware wallets, Ledger, and take control of your digital security today at ledger.com. All right, back to the show. So yeah, I mean, to your point, like the biggest thing that's driving markets right now is just like pricing in / pricing out of right now Trump trade, because he's the leader in betting markets. Quinn, I want to pass it to you and hear a bit about what you're seeing in there, because it feels like we've kind of went to this over the last week since we last talked. It was like we went quite a bit priced into Trump trade. You know, DJT was soaring, and now we've come back lower. What are you seeing in that perspective?
So Tyler laid out that what's happening in the market right now is maximum fear. This is incredible amount of hedging in equities with the VIX and implied stock volatility, and the fixed income market with the move. So, the move is positively correlated with yields. Normally when yields spike because it's an inflation scare or some other sort of scare, it's a move spike with yield spike. And we've seen that. And the thing is there's so much baked into this event. And I disagree. I feel like this reminds me of the time in college at school before these big finance exams. I would feel very prepared, usually ace them. But one time I went to the library before the exam and it was packed, like, because everyone's cramming. And you could just feel this enormous amount of anxiety when you stepped into that room because everyone's freaking out because they're unprepared. And then you start questioning yourself. You're like, man, should I be like a lot more scared than I am? Like everyone is freaking out. Like in this, like anxiety is palpable. That's like right now with next Tuesday. Like you walk down the street and you're like, I'm an optimist. I'm like, if Trump wins, if Kamala wins, everything's going to be moving on. And you walk down the street and like, you can't even talk to people. I mean, it's like this incredible anxiety, and you're seeing it in the market. So, okay, that's what it is. The reason I think it's unfounded is, and a lot of like narrative is twofold. One, when you compare 2016, 2020, and 2024 polls and the results from 2016 and 2020, at this juncture in 2016, Trump was down by 4 or 5 and he won. At this point in 2020, he was down by 6 or 7 and he lost by 1 or whatever it was, 1 or 2. And today it's flat or he's up by half a point or something.
Yeah.
Right.
Just to quickly show the Alice Intel polling, which I believe was the most accurate in 2020, has Trump up in the national polls right now. Further closing polling here. So just to show like what you're saying.
So my point is, out of the last 3 presidential elections, removing this infiltration of the last 3 months kind of psyops attempt that has gone on to concoct this narrative that it's way closer than it is. This is when you just look at what the polls said before and what the outcome was, and you just assume, you can assume differences, and the pollsters updated their methodologies, but I don't give them that much credit because there's still a clear media bias. It's shaping up to be more landslide in one direction than the previous 2. Okay, so if you believe that the pollsters, to have that view, you have to believe that the polls have not fully corrected the mistakes from 16 and 20, which I don't think they have. On top of that, historically, 10% of elections have been contested, right? It's not a big number. I think like 70 to 100 or whatever elections in the U.S. history, and only 10% have been contested. So it's a very, right, long tail, left tail, long tail probability of it being contested. And thirdly, don't forget Joe Biden's in the White House, right? Like this guy is, disagree with his policies, whatever. He's a moral guy. He believes in the values of the U.S. Constitution, the Electoral College, upholding the integrity of the U.S. He will be, mark my words, it's going to be 10, 11, 12 p.m. Eastern, at night of the election. If Kamala's going to lose, he will be the first to call her and say, you have to concede this, and no funny business. people are forgetting, like, in all this hoopla, that there's like a lot of rational people here. And similarly on Trump's side, right? Like there's a lot
Yeah.
of,
Do you think
like,
he'd concede pretty quick if it was obvious?
he's surrounded, like his team is some of the smartest people in the world, like Elon Musk. Like disagree with their views, but like these guys, like there's so many rational people here, despite what the scare tactics of everything. Like either side, there's a lot of rational, intelligent people in and around this event. So the combination of that, I have faith and trust in, despite all the hoopla in the system, this part of the system. And I think actually it's shaping up to be more lopsided. So I think this fear is, I understand why you hedge. I understand all these things. But I just feel that a lot of this is unfounded. And then on top of that, I fundamentally disagree with the commonly talked about narrative of, if Trump wins, let's assume because he's ahead in the polls, let's assume he wins. Because if she doesn't, then obviously if she wins, obviously yields are going to fall, probably the dollar weakens, things like that. But I think it's actually, he wins over a month horizon, let's say, a sell the news and yields. I think it's a sell the news in the dollar, because let's talk about why everyone's super scared about his election for yields is the deficits and people assume spending. Okay, let's start with energy policy. Whose energy policy is more deflationary? Drill, baby, drill, or prevent fracking? Like, that's pretty straightforward. Number two, geopolitics and global war versus peace and negotiation and a business deal versus shooting guns and bombs. We have 4 years to see which was more peaceful and which was more kind of war hockey. And I think it's, Trump's was just, he doesn't want to get involved. Like, and that's less spending. That's deflationary. And then the last thing would be, I don't know why no one's talking about the Elon and Lutnick's Department of Government Efficiency thing. There's only one side here even talking about cutting costs, and it doesn't get any attention in the media. And people just saying, oh, he's going to be horrible for deficits. He's going to be horrible for deficits. If deficits are bad for markets, and Trump's getting his advice from all markets guys, CEO of a large investment bank, best most successful capitalist in the history of the US, JD Vance, venture, like, he wakes up, he tweets about S&P 500 new highs, and he goes plays golf. Trump, like, if there's something, i.e. deficits, that are causing yields to blow out and the market to fuss, he is a markets guy. So anyways, there's just a lot of things I think are completely misunderstood around reality of, like, looking at history, and obviously both sides are saying 25,000 free house payment and cut taxes on this, but I just really strongly disagree with, like, where these knock-on effects are being perceived. And so for that, for these reasons, I'm a big fader of the election vol, the election contested risk. And in either case, crypto, particularly, people are very, very focused, thinking it's over if she wins, and it's $1 million Bitcoin if he wins. But in reality, the macro improves just removing this. Like, okay, say she does win, and oh shoot, we don't have the first Bitcoin president. Well, yields are going to plummet. The dollar's going to plummet. You're going to look at oil price. It's low. You're going to look at the Fed. They're about to cut another 2 times. And you're like, well, Bitcoin went from 25 to 75 last fall to January or March on great macro and none of this other Trump stuff. And so the macro's pristine. And then if he wins, I still think it's a sell the news in yields and the dollar. And you have so anyways, long rant. I just think that, like, this hysteria in the market, like, I just can't wait for the election to be done. Obviously there's tail risk. Obviously, if it's 2 a.m., it's neck and neck.
The tail risk is so bid up though right now.
Exactly. Like,
yeah.
And I'm not saying go tilt long and, short the VIX and all these things. You got to structure your portfolio to benefit in, either outcomes. But I am fading all of this hysteria. Like, maybe I'm too, I'm just like sanguine about it. I don't know, but I'm trying to block out the noise and stick to just what my process is telling me. And the process is saying, if if the election were not this crazy vol-inducing scare thing out in the horizon, that like the macro is so prime right now.
Yeah, that's really the takeaway. Regardless, like I'm pretty strongly in the Goldilocks camp for macro right now, and whoever wins won't change that.
Look at this. You go to slide 38. This is a great, reminder here. This is JP Morgan's US Q3 reporting season. So far, 55% of the companies in the S&P have reported, 75% have beaten estimates, albeit those estimates dropped. EPS year-over-year growth has been 9%, which is pretty damn good. And you can do it by sector. Energy, materials, those are actually missing, which is good for inflation, right? Industrials, 75% have been beating estimates, but let's see what else we got here. IT, 79% beating estimates. This one's really interesting. Financials, if you look at KRE, it's about to break out to the upside here. That wouldn't happen if the economy was really, really crappy.
But Tyler, I thought the unrealized losses are going to send us to the fucking ground here.
Yeah. I mean, so this is just a good gut check that, I don't know, after earnings, you're not going to get any incremental, info really. So the only thing we really have to worry about is like a sovereign bond market blow up, which David Zervos had a great one today. I mean, maybe I could just say this is a great snippet from Zervos. The recent run up in Treasury yields has injected some adrenaline into the never ending parade of debt and deficit alarmists. CEOs of Fortune 500 companies, CIOs have sent $1 billion investment portfolios, ivory tower academics, leaders of multinational government agencies, leading central bankers, and of course, elected officials continuously warn us about the risks of unsustainable deficit spending. And when long-term interest rates rise a smidge, they start to amp up even louder. That's just the first paragraph. But basically, he just roasts all the people saying, deficit spending is going to cause this sort of spiral and yields are going to go to the moon and everyone's going bankrupt. The market's telling you, the bond market's telling you that the corporate bond market, not the treasury market, is telling you that everything is kind of fine here relatively. This is just a freak out in treasury yields. And Zervos basically says, don't anticipate this like super spiral of yields to keep happening.
Yeah, I agree. And to that point, maybe we can entertain a little bit of the debt doomer treasury stuff. I promised I would go over this week, but we got the QRA this week, the Treasury Borrowing Advisory Committee quarterly refunding announcement. Acronym time. It's acronym time. It's time for me to nerd out and for Tyler to talk about vol controllers.
Boomer acronyms. I love them. Maybe they'll come up with another one next week.
Yeah, we need some new facilities, and I'll get some more for sure. Okay, so this is something that became very popular when deficits started to blow out, and we got the whole higher for longer narrative, and suddenly everybody decided to become QRA experts. And basically what this shows is that every quarter we get to learn two key things. We get to learn how much does the Treasury plan to borrow, and how much does it plan to issue debt, and how is it going to issue that debt in terms of the composition. So what do we learn? We learned that this coming quarter, the TGA balance, which is basically the Treasury's checking account, and basically what they do is try to target to have about 5 days or so of operational liquidity in there at all times, depending on what's needed in terms of outlay. So we learned that. And then we also learned that they plan to borrow. Let me just make sure I got the right number here. They plan to borrow $546 billion this coming quarter. And then the next quarter, January to March 2025, they plan to borrow $823 billion. So that's a $277 billion increase in debt borrowing. A big reason for that is what we're seeing here in just the change in the TGA account movements. So right now we're at about like $880 billion there. They're planning to draw it down to $700 billion over this next quarter, but then they want to bring it back up to $850 billion. So, roughly $150 billion of that $277 billion increase is attributable to the dynamics that's going to be occurring from the TGA account. And so what does that look like? So basically, take that up. And one important caveat here is that anything after January obviously is going to be dependent on whether, right now this is Yellen and the Democrats administration running the Treasury. So for this to actually occur, they would have to be reelected. We won't know who's going to run Treasury for Trump if he wins, or what their plans will be there. It could be different. But as it stands right now, what we're seeing here is that there is a substantial increase in the percentage of Treasury issuance that would be T-bills. So whereas this coming quarter, it's going to be at roughly 13% of total issuance being bills, the next quarter there, that big increase that we're seeing is up to 45%. And the reason for this is because we live in this weird new world where, and this is what we show in the next chart here, we live in this world of now we have forward guidance for Treasury debt issuance, which is just the most insane thing I've ever heard. But that's the world we live in now. And part of that forward guidance mandate that Yellen has decided to take up is basically saying that we don't plan to issue any new duration onto the market. So what that means in simple speak is that we decide to issue a certain amount, and you can see it here in this chart, is that every quarter we're going to issue the same amount of dollar value of, say, 10-year bonds, and we're not going to change it. So if we need to borrow more money, bills are going to take up the mantle. And there's a variety of reasons that you could attribute that to. You can make the argument that nobody wants to own long bonds, like we've been talking about this whole show, is that just bonds are pretty much cooked in this current circumstance. So if they're going to start unloading more supply on that market, you can make the argument that the long bond is not going to do too well in that situation. You can make the argument that Yellen is trying to play games where she's trying to wait out for lower rates to basically refinance. The issue with that is part of that cost of waiting out for lower long bond rates before basically switching out that debt is that bills have a higher yield than long bonds right now. The curve is inverted. So what's that mean is that they're actually paying up more interest on that short bond, those short bills than the long bond. You can make the third argument that this is all political games. As long as they don't issue that much duration on the long end, they can at least keep long bond yields somewhat manageable. There's a ton of demand for bills. You can make the argument that issuing T-bills like they are here is effectively money printing. I'd probably agree with that. So you could also make the argument that Yellen is juicing liquidity and juicing markets. But the fact is, as you can see here, going from this quarter to the next quarter, there's a very substantial increase. And to be fair, and this is something that the great QRA expert Andy Constant has noted here in some forecasts, is the next following quarter after that during the March one is tax season. There would be tax receipts. We'd probably see negative bill issuance, so that would reverse quite decently. You can see in his forecast it goes from like a 43% composition of T-bills being issued down to like negative 75% because of that negative bill issuance dynamic. But again, I wanted to walk through just to at least explain this, but to the point of what Tyler just mentioned in terms of just like fading the fear around this is, less and less people are talking about the QRA. It's back to being mostly just nerds like myself that geek out on it. It's maybe you can make the argument that is driving markets, but it's not as much in the common narrative that it was a year ago.
Well, I think the issuance on the bill side is really fascinating because, they have all these plans, like the government's not stupid. And yesterday, the Treasury released a report on how stable coins increase the demand for US debt. If you have, if you're trying to kind of create new buyers of debt, stablecoin are one of the largest buyers of US Treasury. It says Tether holds, let's see, 80 billion in debt alone on US Treasury bills, which is kind of nuts. So if you grow the stablecoin industry, you grow the demand for Treasury bills. And I think that's, the issuing on the front end, you got to figure out funky ways to create the demand.
Because a lot of that demand has come from reverse repo, but that's going to be running out pretty soon. So there's going to be somewhat of a crossroads soon.
Yeah. So I don't know. Well, they'll always pull something, a magic out of their hat, Yeah.
There'll be a new acronym. What are you going to say, Quinn?
I think you laid out the QRA stuff well. I think the biggest takeaway is just, we're continuing to see increases quarter over quarter in the amount of debt they need to borrow. And that's not new to anyone. That's just function of the deficits. But the point is, they have proven they have ways to deal with it, which is one, draining the TGA, especially if there's any issues around the debt ceiling on January 1. We saw that tactic in 2023. They just drained that down while they were negotiating. And then two, front loaded with bills, and there's still a $200 billion in the reverse repo that softens that blow and releases less duration onto the market. So, they have these tools. The tools are not as the tool shed is not as full as it was a couple of years ago, but they're still there. I think, just to really reiterate this move, the bond volatility point is, I feel personally that, aside from who's president and what we often see when there's a new, elect, is there's kind of a month or 2 or 3 months of movement in assets that correlates to what people think, what the common narrative is around that new elect's policies. And then we see what reality happens years after. For example, under Trump, yields skyrocketed and on pro-growth, et cetera, and the dollar along with it. And then the dollar was weaker pretty much throughout his whole presidency. And with Biden in 2020, it was quite opposite, actually. The dollar was actually stronger through most of Biden's presidency and yields kind of rising. So there's this, like we talked about, kind of expect a lot of funky stuff, but also just be skeptical and open-minded, because I feel that the forward policy path for the Fed is as kind of straightforward as it's been in many, many months. And alongside that, I feel that the market is the most appropriately priced for Fed forward rate cuts and policy as it has been in many, many months. So on that notion alone, you're thinking, plus oil is at the bottom of the range and can't sustain a bid, and wage inflation pressures falling, house inflation pressures falling, like no inflation volatility. And so you're sitting there and you're like, this seems like it's kind of the least unknown forward, rate environment we've been in a while. And so why is the move so elevated? And you look at every election and it's an election thing, 2020, 2016. And in both those cases, we had different elects, different policies. 2016 was red sweep. 2020 was Biden win with a split Congress, or maybe it was, I don't think it was blue sweep. But in both cases, the move cratered. And I just think, like, outside, again, harping on this, but outside this election, the like unknowns out there are not that high, in my opinion, relative to where we've been in this whole year, basically.
Yeah. The Fed path is a lock, like, especially after today's print. Like, that is, no matter what happens with the election next week, the Fed's going to cut 25. They're probably going to cut 25 in December again. Like, that is pretty solid in there. So I totally agree.
And the rolling off of these volatility metrics, when there is an outcome of the election, are typically some of the most liquidity positive market moves you can have. Obviously, falling yields, very liquidity positive, falling dollars, liquidity positive, but even more so than that, falling volatility and unknowns in the market is one of the most liquidity positive movements you can have. And so I just think, let's get through Tuesday and Wednesday. But it is just an incredible amount of fear priced in.
Well, maybe we can wrap up here. We're just doing a little victory lap for you, Quinn, on MicroStrategy. And with respect to compliance and that, Tyler, chime in where you can or where you cannot, or just stand there. But you can just stand there smiling with no comment. But I want to open it up to you, Quinn, to just give a quick recap of what you mentioned last week in terms of MicroStrategy, and then what actually occurred in their earnings, because I think it was really interesting. I'm actually going to be interviewing Dylan LeClaire in an hour, which is going to be really great for nerding out really deep on this. But just want to get your take on what you saw and how similar was it to what you expected happening.
Yeah, so summarize, you had the most aggressive run up in the premium of MicroStrategy's enterprise value and equity value share price relative to its Bitcoin holdings that we had seen in many, many months. And it was an aggressive 50% plus move in the premium over Bitcoin in about a month since its last convert issue in mid-September. And you had this event sitting on the horizon with earnings, where the blackout rolls off, where they can announce capital markets transactions. And with a premium like that, there's just incredible incentive for them. That's how they grow Bitcoin per share. That's how they increase the value to their shareholders, is issuing equity at a premium because of the volatility in the stock, at a premium to its book value, buying Bitcoin at fair value, and it grows book value per share or Bitcoin per share over time. That's what they talk about, this yield metric. And so you just had this incredible incentive to hit the capital markets. And so, yeah, honestly, I wasn't expecting just pure straight equity. I kind of imagined they would throw a convert in there. But what this does is, instead of having to go back to the market every time the premium gets high, they issue $1 billion convert, knock the premium down, wait a month. And it's a super lumpy way of accumulating Bitcoin that also coincides with pops in Bitcoin price or pops in the share premium. They're always buying the tops. This kind of allows it to be more smoothed over time, where day to day they can be kind of TWAPing shares and TWAPing into Bitcoin. And yeah, I mean, it's like one of the biggest kind of equity ATM offerings, in recent history. And it's obviously a huge percentage of current market cap. But the craziest thing is the shares were down 12% after market, which you'd expect, a hit. And then yesterday it was trading green. And you're like, there's a lot of, we could go deep down the rabbit hole and about why that is. And it's kind of, there's a lot of unknowns, and you're trying to forecast people's propensity or demand for the shares of MicroStrategy over Bitcoin. There's a lot of unknowns, but the moral of the story is the premium remains aggressively high, and the incentive to issue shares and buy Bitcoin remains high. And so I kind of wrote in that thread, you remove the left tail because of Bitcoin right now, where the premium's still elevated, because he has a lot of room to issue equity and therefore buy BTC. And I'm just not sure that's something that can be priced into the market, because he's not going to go out and dump 5 billion. I was joking when you tweet, you're like, what questions for Dylan? And I was like, why can't he just do this in one market order? And he's going to be methodically, slowly, not trying to, cause big movements in the market. So yeah, it's kind of like a multi-month TWAP that kicks off when his blackout's over, which I think is like Monday, usually 1 or 2 days after earnings. So it's pretty bullish.
Yeah. I think the big one is like, people were kind of losing their minds over the last 2 days seeing this. And, just to really contrast it, I saw, like a pretty funny tweet where it's like, okay, Coinbase announces like a pretty significant buyback and the stock is down pretty significantly. Whereas MicroStrategy just, basically offered, like 21 billion in equity issuance, and the stock is up, and it just drove people insane. And like, my big question is, at what point does this go from, oh, this is the most speculative, irrational bubble of all time, people don't understand, capital structure, they don't understand what they're buying, to, oh shit, I was actually wrong, and this is actually like a new, like capital treasury mechanism that we're seeing unfold here. Like, I wonder at what point it changes for people,
Yeah, probably sell when that's the case.
Probably.
When sentiment shifts.
I'm not going to speak specifically to that, but in general, like MetaPlanet, guess what the best performing stock? MetaPlanet is up 1,151%. You should talk to Dylan about this.
Yeah.
And that's far out past it. So it's this is an ARB that's going to be here. When you have the sovereign diluting your currency base by fiscal or monetary means, and it won't let credit spreads widen, generally speaking, because of this giant dilution, this ARB will be there. It's a generational arbitrage. And
Totally.
more and more companies will be forced to do this as this generational arbitrage keeps going because of the giant liabilities of baby boomers. That's all this is. That's all this is. It's pretty freaking simple. Generation before has basically put, the vol controllers have stifled volatility so that they can put giant gates up in their monopolies. And then they can't let the debt default. So because they have to pay themselves out all the liabilities on the public side of things, like Medicaid, Medicare, Social Security, yada, yada, yada. That's I'm probably going down too much of a macro rabbit hole here, but that's the reason why this ARB exists, and it will continue to exist.
Well, look, guys, that was a good episode. I personally cannot wait to get through the next week or so. We'll be chatting next week, next Friday after the election. If what we think is all going to happen, which is that everything's going to be okay, maybe we can start the show with a meme that's just like the nothing ever happens meme. I would love for that to happen. I think it's pretty likely, but yeah, it's going to be a big week. It has been a big week. We'll see what happens.
If there's no winner, the VIX is going to go to 50. We'll get a volatility guy on here next week if that's the case.
Yeah. All right, guys. Thanks again. Have a good weekend.
Have a good weekend.